as we're heading into this second half of the year, we're all now facing the rising global construction costs, inflation, the threat of multiple interest rate rises, potentially a market adjustment. But there's a consensus that the demand for logistics real estate globally is not a transitory thing, and that hopefully inflation could well be. And I think today, with some fantastic insights,
you can see how global investment volumes have changed from 2019 onto where we are in 2022. And, the big story, is beds and sheds. You can see, industrial logistics was 16% of global real estate volumes back in pre-COVID times, and it's now up to 23%. I think with rising interest rates, there is going to be a correction. Quite what that is remains to be seen, because obviously we are all logistics and industrial specialists, and we're looking at the logistics market. But actually, we need to think about this in a cross-sector environment. Investors will be looking at offices, they'll be looking at retail, they'll be looking at the living sectors, they'll be looking at alternatives, and actually rising cost of debt impacts everyone.
Those headwinds, they really look scary. I mean, they're big macro themes, inflation, war, interest rates. But the tailwinds, and maybe you call it recency bias, but I think there's a we are now looking at the headwinds maybe more than the tailwinds, but the tailwinds have been very strong for 2 years, and they've really propelled our sector through COVID, and everybody's seen how resilient it is. And logistics is now, it's a conversation over breakfast.
We start gradually to adjust. This is for me the key word for the next quarters, these adjustments, because many things would be moving. We don't know exactly how much and what would be direction. Kevin mentioned construction costs, etc. So we will have to be really very reactive, proactive, to adjust ourselves. And different markets, we have different adjustments required. But I think we are leaving traditional, maybe not traditional, but recent development environment kind of boring, when everything was predictable, rents predictable, cost of capital predictable, and we are coming back to what's, I would say, more natural. For example, for a developer, when we have to be creative, proactive, and adjust.
Brazil is a very tough market to think about right now. It's a volatile year for us. We have presidential election this year in October, so this has been precified already. I mean, every time we have presidential elections, the scenario is always even more volatile. But on the investment side, it's very tough to make any decision right now in this scenario. I mean, regardless of who wins the election, I mean, at a 13% interest rates, I mean, most of the allocation will go to fixed income, which historically has been the case in Brazil. 70% of the allocation in Brazil historically has been, concentrated in fixed income.
When I tried to analyze what's going on, I tried to look at and get some historical perspective. And what it makes me think of is, the second oil crisis in 1978. And if you look at what happened in 1978 and you see research around oil prices and its impact on inflation, I think you really can't discount the increases in oil prices and the impact that they're going to have on prices. If you add to that, all the supply chain problems that we've been having for the past 2 years, and you add to that then the crisis in Ukraine. Ukraine's a big producer of iron and steel, and a big producer of wheat. So all of these things have impact into the ultimate cost of goods.
We're looking for confluence between population density and logistics infrastructure. And what that means is exactly to Kevin's point. I mean, I'd be curious and love to see that research. Historically, the data point that folks have used, and I know PROLOGIS has done a lot of work on it, CBRE and JLL did some work on it. I know Kevin's group, SAVILLS, is doing work on it, but occupier costs were anywhere between 5 or 10%, like he said, and transportation costs were anywhere between 50, 60, 70%. And so if you run the math out on that, again, occupiers become very cost conscious, just like everybody else, and it ends up creating an inelasticity for rents, right?
How do you look at the rest of the year into 2023 when considering your investment strategy?
Kevin, your research has shown that we're all staying relatively optimistically, if not sat firmly on the fence for the rest of the year.